Welcome to HR Minutes. I'm Tim Timmons, the HR Director for the South Carolina Chamber of Commerce, and today we have with us Mike Brittingham from the law firm Nexsen Pruet. Glad to have you with us today, Mike.
Glad to be here.
Mike serves on several of our committees, and one of them is the Employee Benefits Committee, and helps us with a lot of issues throughout the year, and we appreciate it. And specifically today, we wanted to talk to Mike about, if I understand it right, you have to correct me now, the Department of Treasury and the IRS has basically said, we want to help your employees save money for retirement. We're going to come up with these new regulations, new guidelines, and anytime the IRS wants to give me some guidance, I get a little concerned. So can you talk a little bit about what's happening and the changes for us?
Well, certainly. Most recently, the IRS issued a series of revenue rulings and notices set to encourage employers and employees to save more for retirement. Their statistics show that about half of working Americans actually participate in a tax-favored savings plan, and then of the half that don't, only about 5% of those actually save for retirement. So these new announcements are intended to encourage employers and employees to save more for retirement.
Do they require employers to do anything, or are they options for employers, Mike?
Well, that's a good question, because really the new guidance requires no changes of an employer. What these new pieces of guidance from the IRS do is, one, allow for some new guidance. It gives some sample plan amendments, and really just give some more opinion from the IRS of how certain types of arrangements might be implemented to improve employee savings rates.
So these changes, if implemented, would require SPD changes and those kind of things?
That's right. At first, of course, you would start with amendments to plan documents, and as you make those changes, then you would either revise your summary plan descriptions or perhaps issue what's called a summary of material modification to explain the changes that you make into your plan.
You know, one thing that I was interested in as I read, I think maybe your law firm put it out, discussions about automatic enrollment. You know, I've heard you can't do it, I've heard you can do it. Can you talk to us about automatic enrollment, what it is first of all, and what these new changes mean for automatic enrollment?
Certainly. Well, automatic enrollment is really a phrase that describes a certain mechanism that an employer can use in their tax-favored 401k plans, where an employer would say either to a new employer or to their workforce generally, look, we're going to, instead of paying you 100% of the cash compensation we promised to pay you as part of working for us, we're going to pay you, let's say, 97%, and 3% of what we would otherwise pay for you, we're automatically going to put it in the 401k plan. I just use 97 and 3% as examples, but that's what automatic enrollment generally means. Now, you can do it either through a custom design plan that an employer establishes its own program, or you can do a qualified automatic enrollment program. And that system would require a plan amendment, as would a custom design, but a qualified program, you would establish a certain threshold of automatic enrollment percentage or amount. You would match that amount based on certain statutory requirements, and also allow employees to opt out if they don't want to be in the automatic enrollment. In exchange for doing the automatic enrollment program, an employer can forego what's called the ADP, the actual deferral percentage test, and the ACP test, the actual contribution percentage tests, which those tests generally can limit the amount higher paids can contribute to the plan, and an employer can match to the plan. So those are really some good programs that are available.
So, and I think what I heard you say, Mike, that while it's called automatic enrollment, employees still have the option to get 100% of their pay, not 97 versus 3 in your example. They can opt out of that.
That's right.
Okay.
And automatic enrollment, here again, you had asked me at the beginning, do employers have to do this and do employees have to do it? And the answer to both of those questions are no. And so in an automatic enrollment, an employee can always opt out. That's clear in the new guidance. What's also clear in the new guidance is employers don't have to do it. This is just something new, or some new guidance on auto enrollment.
Well, what about, I think the term was gradual automatic increases? I'm not sure I know what that is.
Right. Well, in some automatic enrollment programs, what an employer will do in its plan is say, we're going to start you out at 3%, and then next year we're going to increase you to 4% and 5%. all along, the employee can opt out. One of the things that's in the new guidance, there have been some restriction on when those automatic steps happen. Did they happen on an annual basis every year for everyone, or would they happen only when pay increases came on, or would they happen on anniversary dates? And the IRS has given some guidance on how you can do that, and the guidance allows for more flexibility in how those automatic increases are implemented.
Good. How about specifically, I know even at the chamber we've talked about this, the paid time off, the vacation, whatever the right terminology plan they're using, is the ability possibly to use PTO or leave time when you leave an organization, have that money's contributed to your 401k. Is that an option, or?
That's right. The new guidance, what the new guidance says now, Tim, is that both on a recurring basis, every year as a PTO or leave year ends, an employer can establish, and notice I say can or may, it's not you're required to, but an employer can let otherwise forfeited amounts in PTO either on an annual basis or at termination if there's some unused paid time off, whether it's called PTO, vacation, sick pay. The dollar value of that otherwise forfeited time or right could either be voluntarily elected to be contributed to a 401k plan, or it could be an employer contribution, like a profit sharing amount. Now,
I'm sorry, Mike.
That's all right. One of the things that I think is important to note, that even though an employee or employer can do those things, the normal code limitations and restrictions apply. So even though someone could contribute more on a forfeited leave amount, you still have that annual amount, the 402G limit, you'll hear that referred to, the 16.5 limit for this year. You can't exceed that.
So that's included in there.
That's right.
So from an employer standpoint, let's talk about employers for a minute. If they have a policy that says when somebody leaves with unused vacation, we're not going to pay that out. That's in their handbook. If they went to something like this, that would be extra cost for the employer, correct?
That's correct.
Okay. So you got to think through all that, what they want to do, and what's best for their employees and their locations.
And again, it is a voluntary thing. But before, we've had no real guidance on if you wanted to do this, how could you do it? And now the IRS has not only given us guidance, but they sanctioned doing this type of thing with otherwise forfeited leave time. So it's just another tool in the toolbox, so to speak, for an employer to use to help employees save for retirement.
Okay. Now you mentioned something a minute ago about a qualified plan. Now I know this is like a quick interview and you haven't got time to go into it, but for the people who are watching this video, can you, in a minute, tell us what the difference is in a qualified and unqualified plan?
Right. Well,
that's hard to do. But.
Sure. Well, what an employer gets with a tax qualified plan, especially with a taxable entity, is that to the extent contributions are made on behalf of an employee, the employer can deduct those amounts in the current year. And the employee, while they may get contributions in the plan fully vested to their credit and that they will take at retirement or another distribution event, the employee actually sort of owns that right. They're not taxable on that right in the qualified plan until they take a distribution. So what you have there is a tax-favored situation where an employer can take a current deduction for a current right transferred, and the employee's not taxed on it until they take a distribution that's allowable under the tax code.
So when we talk about qualified, we're talking about tax law.
That's correct.
And so often with benefit plans, we're talking about tax code.
Exactly.
If I'm not mistaken, I think 401k is actually a tax code.
It certainly is.
So we deal with it all the time.
That's right.
So what you're telling our employees, it sounds like it. Look at the options, understand the options, look at the changes, see what applies to you, what doesn't apply to you, and quite frankly, call your attorney to make sure it makes sense for you. So we appreciate you being with us today, Mike.
Well, thanks, Tim. It's good to be here.